Hi, my name is Shrans, and today we are going to do a basic financial analysis of a company whose products are used by millions of Indians on a daily basis. Yep, it's that large, right? But before we start, please remember that this is not investment advice. We're just trying to understand the financial performance and position of the company. So let's get started. The company that I'm talking about is Hindustan Unilever, or HUL as it is commonly known as. As you might know, it is an FMCG company which sells across F&B, home care, personal care, right? It has so many brands that we probably buy all the time, right? Every month or every week, right? And as per the company, its products are purchased by at least 9 Indian households on a daily basis. So that is how huge it is, or that is how much reach it has, right? In my understanding, it is the largest FMCG player, the largest listed FMCG player actually. Amul is not listed, and it is probably the only company that has revenue that is even greater than HUL. But in the listed space, HUL has the highest revenue. So we'll get started with the financials, then we'll move on to the metrics, and we'll wrap up with the highlights. So if you look at the financials, I mean, revenue has been in a smooth upward trend, but the challenge here has been growth, right? With revenue, if you look at these couple of years, very solid growth. But after that, the growth hasn't been that impressive, right? It has mostly been, I mean, it has been low single digits or sometimes even high single digits, but not anything considerable, right? EBIT has been slightly better. So EBIT is up 3.6x. It has a CAGR of 15.3%, which is still good. PAT is slightly lower at 12.7% CAGR, and PAT actually decreased in just 1 year here. Right after that, it has again recovered. So that is probably why, I mean, it has a slightly lower rate than EBIT. So overall, on the P&L side, slightly challenging growth prospects here for the company, and not the best of growth in terms of revenue in the recent years, right? Coming on to the cash flow, right? So if you look at the cash flow, it is up 4x, right? And it is the cumulative cash flow is greater than the cumulative PAT. So company's cash conversion is on the stronger side, which is more or less understandable for a company in the FMCG space. If you look at the CFO to PAT, it has been revolving around, it's been slightly more volatile than PAT, but largely it has been, greater than PAT. In 5 years, it has been greater than PAT, and in the total as well, it is greater than PAT, right? The other two aspects of cash flow, which is the CFI, investing and financing activities. So if you look at, I mean, CFI has been, positive, negative, right? So the reason for that is, of course, the company is making investments into its fixed assets, right? But apart from that, it also has several investment related transactions, investment income, or just buying and selling of investments, which has led to the difference leading to, positive or negative net flow. So that is why this looks slightly volatile. This does not mean that the company is not reinvesting into its assets. It is, but then, due to the investments, the numbers seem like they are right now. Cash flow from financing, most of this relates to dividend payments, right? There have been far and few borrowing transactions. The company virtually has no debt, right? But most of these financing activities actually relates to dividend payments, and the company has been paying huge dividends, right? So if you look at the net position here, so out of all the operating cash flow being generated here, only this much, this is the net figure obviously, has been invested, and the remaining has actually been, paid out. A lot of this has been actually paid out as dividends, not completely, but majorly, right? Equity has grown at a decent rate. It is up 3x, right? And the reason for that, I think, it is because the company has paid a lot of dividends, right? So its capital and equity base have remained, haven't expanded as much as well. It's just relatively smaller, the capital and equity base, right? Non-current liabilities far and few. I mean, if you could look, it's probably some sort of increase here as well in the last 3 years. We'll have to check that. From my understanding, it is not borrowings, it's probably other liability items or provisions or something like that. But we can take a look at that as well. Current assets have been on the upside. The increase in 1.7x versus a 2x in revenue, right? A little bit, a part of this would also relate to investments as well. So that is also something that we'll have to see. Current liabilities also, I mean, they've broadly operated in a range from here since here, right? Because here it's also exceeded 9,000 crores. So from here to here, they've broadly operated in a range, and this is understandable. with current assets, the increase has been slightly more dominant, right? And that is why the balancing figure is slightly, the net working capital figure has increased quite higher compared to revenue. So net working capital is about 22.8% versus a revenue of 7.9 or 8%. So that is majorly due to the fact that current liabilities have stayed in a range and current assets have increased, but a large part of that current assets are also investments, right? Non-current assets continuous reinvestment into assets as per the requirements of the company. The growth has been limited and the investment has also been limited. It has not been any sort of major expansion, so to speak, that I can identify here, right? Okay, now let's quickly also once again go through the growth in the different financials, right? Revenue growth good in couple of years, but after that it has not been the best, right? EBIT slightly better, right? So single digits only in 2 years, but overall it has been better than revenue, right? PAT again, it was single digit here, then negative here, single digit here, but apart from that, slightly again better than revenue, but not as good as the EBIT, right? Cash flow from operations, it's slightly volatile, but overall in the overall compared to PAT, it's been better. Equity, it increased quite well here, but then in the last 4 years, it's not increased as much. I would assume that there has been a higher dividend payout in the recent years as well, right? Assets, continuous reinvestments into assets, whether fixed assets or whether current assets as well, but a substantial part of assets are also held as investments, right? Net working capital, we've talked about. Liabilities, mostly there are current liabilities, right? So if you look at the ratio of current liabilities to non-current liabilities as well, most of the liabilities are actually current liabilities, right? And this is something that you can naturally expect from an FMCG company, and non-current liabilities are just insignificant, right? All right, so let's move on to the metrics now. And this company is possibly the one of the companies to have the highest ROCs and ROEs. Probably Nestle is the only company that has a better ROC and ROE in this company, or HUL might even have it better. So those two are the companies with such high ROC and ROE figures, right? So if you look at the minimum ROC is 72% and the minimum ROE is around 63%, right? And if you look at these years, then the company has generated more profit than its equity base. This is what is basically telling us, right? So, and if so, it's based on how it's been going, or based on the median ROCs or ROEs, you can assume that within 5 quarters, company is able to produce enough earnings which is equal to its existing capital base, right? So it's around 80%, right? If you look, so within 5 quarters, it can generate enough profit to cover up its existing entire capital base, right? And if we look at the the breakdown of ROC and ROE, then we realize how it's going. Because if you look at the margins, then the margins aren't the maximum, or margins aren't on the high end when we compare to probably other industries, right? So margins have improved, so that is a very good thing as well. So margins were the lowest in this year, and now they're at their highest. So the margins have consistently improved, but the real driver of ROC and ROE, so to speak, is the asset utilization. So what this basically means, so for example, if we look at these years here, probably let's pick up this one. So the company is producing 4.28 rupees of revenue for 1 rupees of capital employed, right? And similarly, for 1 rupees invested into assets, it is generating 2.21 rupees of revenue, right? So every year it is generating a lot of revenue by utilizing its capital very quickly, right? Because the speed of production is very high in FMCG, so you can use the existing base to do various rounds of, or various production rounds, and use it very well, right? So very efficient production as it seems with the company. The asset by equity position, which is the financial leverage, it has always been above 2x, but the company has been using it very smartly, because most of the liabilities, so to speak, are actually current liabilities, which are very easily covered by the current assets as well, right? And that is why if you look at, compare the non-current liabilities versus equity, then these figures just don't seem material at all, and the company doesn't have borrowings as well, right? So very smart usage of leverage as well by the company, because often you find that these leverages are below 2x for the best of companies, somewhere around 1.5x, but the company has some bit of leverage, in the sense that it has current liabilities, high current liabilities, which are sufficiently covered by current assets, but then it also magnifies the return that goes to the equity holders, right? CFO versus PAT, we've already talked about. Net cash flow is something that we'll come back to again, right? So if you look at the net cash flow is basically the operating, investing, and financing cash flow. So it has been negative in some years, positive in some years, and we look at the overall picture as well. Working capital, we've already talked about a large part of this working capital. So if you look at the last 5 years, right, the working capital amount has suddenly increased. So it was operating in probably in a specific lower ranges here in first 5 years, and then it has just shot up shot up by a lot here, and I would assume that this has a lot to do with the investments. Significant increase probably in investments, right? Okay, now let's quickly move on to the highlights of the company. So limited revenue growth, slightly better EBIT and PAT growth. EBIT growth has been the best amongst the three, right? CFO greater than PAT in 5 out of the last 10 years. Cumulative CFO is 44,240 crores, which is about like 450 or 400 crores greater than the PAT. So so they're almost very similar. Like very low reinvestment requirements, and majority of earnings are paid out as dividends. This is what I was able to understand from the company, right? So because it is an FMCG company, because it has a very solid asset utilization, then it doesn't need to make large investments. It can continue with smaller amounts of reinvestments into its fixed assets and still generate good revenue. But then also on the flip side, we haven't seen a lot of growth, so these two factors are kind of playing at each other. Majority of earnings are paid out as dividends. So if you look at the cash flow from operations here, and out of this much is related to financing activities. Now, not all of the financing outflow is related to dividends, but major of the, like 80% or 85% even of this is related to dividend payments. So if you compare it versus the cash flow from operating, then the company is paying out majority of its earnings as actually dividends, right? And that is why the equity base has also stayed comparatively lower. So equity of 3x, hardly any borrowings from the company. Financial leverage has always been above 2x, mostly current liabilities, which we've discussed. Working capital trend in line with revenue, I would say, although you could see that the figures had shot up a lot, and that is, I think it has more to do with short-term investments rather than any significant change in working capital policy, right? ROCE greater than 70% in all of last 10 years. These are just unbelievable numbers. ROE greater than 60% in all of last 10 years. So these are just staggering numbers, right? EBIT margin has improved from 12.3 to 22.3, and PAT margin has improved from 11.5 to 17%. Currently, both of them are at their highest, right? So that is also a positive thing for the company. Capital turnover greater than 4x in 9 out of the last 10 years. Asset turnover greater than 2x in all of last 10 years, right? And in fact, these numbers might even be slightly better if we kind of remove the investments from the asset side, or if we actually go down deep enough to identify which of the capital is actually capital and which is not really being utilized into the business, right? So in conclusion, staggering financial performance and very strong solvency position as well. But the challenge remains the growth, because as you can see here, not the best of revenue growth. Although the margins have expanded, which has led to better EBIT and PAT growth, but unless and until the revenue growth doesn't come back, there is only so much you can do with margin expansions and asset utilization, right? So it will be interesting to see how the revenue growth continues in the future, and if that can come along, then everything else is pretty much very well settled for the company. So that is all that I had to share about this company. I hope you found this helpful. If you have any questions or suggestions, you can drop them in the comments below. The link to the Excel sheet is available in the description. If you want to receive more, if you want to receive this and more directly to your WhatsApp, then the sign up link is in the description. I hope you found this helpful. I'll see you again with another company. Thank you so much.